Good afternoon, ladies and gentlemen. How's your Saturday? How's your Saturday? Thank you. Today is the first Guru Talk that Property Guru organized for this year, and it's also the first Guru Talk after the Chinese New Year. So over here, I wish everybody here a prosperous and rich year of the ball in Chinese New Year. Okay, so before I go into my slides, I would like to share with you the outline of my presentation, which is to share with you some of the macroeconomics that is happening around Singapore. The reason why we need to understand macroeconomics is because Singapore is an open economy. So whatever happens in the world will also affect Singapore. And after that, I'll drill down and distill down to more micro level, how as an individual investor, what are some of the strategies you can use to optimize your investment and optimize tax in Singapore. Along the way, if you have any question, feel free to stop me or raise up your hand, or even after my presentation, because let's make it a very casual and interactive session in a nice sunny Saturday afternoon. Okay, Singapore. So over here, my colleague has gotten a trend that the Singapore bank earnings is coming up. And why is it important for us to understand the banking sector in Singapore? Because we know that the banking sector is a barometer of the economic health of the country. So when the economy is doing well, consumers are more confident, they take up more car loan, housing loan, and business are more confident, they take up more business loan. So there's indication that 2018, the banks are performing better. And also, Singapore's economy also ended 2018 on a healthy note, growing by 3.3%. Although by emerging economy standard, 3.3 is not high, but by mature economy standard, 3.3 is actually very healthy for Singapore. But we all know that the biggest story of the year, 2018 and coming to 2019, is the US-China trade war. With this trade war, there are a few things that's happening. US withdraw from TPP, but Singapore, together with some other Asia-Pacific country, also push for another version of TPP. And with the trade war, there's also a relocation of production capability from China to Southeast Asia. So that will actually create more employment opportunity for Southeast Asia. So that is also a plus point for Singapore. We serve Southeast Asia. Okay, so I'll elaborate a little bit more. According to a survey on 430 companies in China, the survey question asked is, have you or are you going to relocate your China-based manufacturing to other countries? And if so, where will it be? So it's very clear that many of these companies in different sectors are relocating the production to Southeast Asia. The percentage is almost about 1/3 of them in China relocating to Southeast Asia, either have started or considering to do so. So when Donald Trump launched the trade war, he was hoping to bring the factories from China back to US, but apparently it's not happening. Instead, what happened is the biggest casualty is US and China, but Southeast Asia will benefit from it. And the reason is very simple, because I've done a lot of market analysis. It costs probably much higher for the manufacturer to relocate the factory back to US, because the cost of production in US is so much higher. But now, China's side, when it comes to coastal region, the cost of production has also gone up. The land cost has gone up, the labor cost has gone up. So to them, Southeast Asia becomes comparatively cheaper. So therefore, it makes business sense for this company to relocate. And many of them are actually American companies. So that's the irony of it all, of the trade war. So it's actually much ado about nothing. And this is another statistic to show you that while 2/3 of them stay put in China, but Southeast Asia definitely will benefit a lot from them. The countries that the manufacturing will relocate to will be namely Vietnam, Cambodia, Thailand, and Malaysia. But Singapore will benefit from more high-tech manufacturing and also being a service center to Southeast Asia as a logistic hub, as a financing hub. So we know that the world today is more uncertain. It's a more turbulent world compared to last time, 5 years ago, 10 years ago, because the political leaders we have today is a very different breed of creatures. We have a disruptor who is the president of the United States, and the disruption will likely to continue throughout his term in the office. So there is really global uncertainty other than trade war with China. He's going to probably launch trade war with Europe, even trade war with Japan. So the world is getting more and more uncertain. Of course, in Europe's side, there's also uncertainty caused by Brexit with the Eurozone. And of course, geopolitically, there's also geopolitical risks in terms of uncertainty in the Northeast Asia, between North Korea, South Korea, and now they're talking about the nuclear talk over there. And of course, the trade war. So when all this uncertainty happen, investors usually try to move their assets around. Normally, they will move their assets from high-risk market to low-risk market. So there is and of course, this is further aggravated by the Federal Reserve raising interest rate. So in the past, US have kept interest rate very low. So when interest rate is very low, the hot money move out of US to Asia, especially to emerging market. But when US start to raise interest rate, the hot money, some of them will move back to US, and some of them, they move out of emerging market because of the global uncertainty. Because when there's global uncertainty, investors are no longer chasing after highest return of the day. They're actually chasing for flight to safety. They just want to protect their investment. So when this happens, definitely emerging market currency will go down. I think we have seen last year how some of the emerging market currency like ringgit, like rupiah, like rupee, all going down. In fact, most of the emerging market in Asia, their currency have gone down versus the US dollar, caused by the global uncertainty, caused by the US raising interest rate, caused by the trade war also. So where do these investors put their money in? They are always safe haven currency. That means when everything is bad, they will try to park their money somewhere. So where is this where? Okay, so other than safe haven currency, another major safe haven is gold. So when the world is more and more uncertain, gold will see the price will also rise. Then other than gold, the favorite safe haven currency is US dollar. So therefore a lot of funds move to US. But of course, for us, we know that to go to US to buy a property is also going to be very tough because of the geography and so far. And the other major safe haven currency in the world today is Euro, which is still standing strong. But Euro now is facing some uncertainty because of the Brexit, and also some of the Southern European country that is facing high debt problem like Italy and Greece. And the other major safe haven currency is Japan, Japanese yen. So yen performed quite well last year. And of course, Sing dollar, our own very own mother currency, is regarded as a safe haven, which is why it's not unusual for you to see when I travel around the region very often, where I met with a developer in Philippines, in Thailand, in Malaysia. It's not unusual to see the chairman and the CEO having their families based in Singapore, because to them, Singapore is a safe place to park their money. They know that if they have $1 billion, they have $100 million, they put in Singapore, the value will be preserved. So for this high net worth and sophisticated investor, they are not looking to make a lot of money because they are already there. They already have 1 billion or 100 million. They don't need to make another billion or another 100 million. They just want to preserve the value of their existing wealth. So for these people, Singapore becomes a very natural destination for them. And it's particularly so for the region, because if you talk about Indonesian, Malaysian, the Thai, the Filipino, for them to park their funds to US or Europe could be a bit far. For Europe, it's a popular destination for Russian, to park their money because of the proximity. And for US, it's probably the South American who park their money. So in Asia, usually it's either Singapore for Southeast Asia or maybe Japan for Northeast Asia. So each of these safe haven has their natural catchment area, which is why you see Sing dollar has performed consistently well versus all the regional currency. There was a statistic done by another associate of mine about an Indonesian rich Chinese who invested in Singapore property 10 years ago. Don't talk about capital appreciation, just assuming the price is the same, but because of the divergence between Sing dollar and rupiah, that guy would really have made 500% to 600% of his capital just by investing some rupiah into Singapore dollar property. So that was why Singapore has always remained strong, and Singapore property always maintain a certain allure for foreign investors. So Sing dollar is approaching the upper boundary of its trading bank. So in short, what this one is saying is that this year they expect Sing dollar to continue to remain strong. So what is the basic ingredients of Singapore's resilience? The first is we have an excellent transport infrastructure. I don't know how many of you have traveled to overseas. When we go to any capital in this region, whether it's Manila or even KL or even Jakarta, it's not unusual for you to stuck in a 3 hours traffic jam from point A to point B. There's this saying that we have when we go for business trip to Jakarta. It's either you appear very early in the airport, way ahead of the flight, or you appear just 30 minutes before the flight, because you cannot predict the actual traveling time. So you probably have to budget about 3 to 4 hours before your flight to go to the airport. So that is the kind of infrastructure we talk about. But Singapore has excellent infrastructure, it's predictable. So therefore, it continues to maintain the allure for many investors. And of course, our unemployment rate is among the lowest in the region or even in the world. So why is unemployment rate very important? Because we all know that property prices is actually being supported by income level of people, right? Only when you have people with income, then they are able to afford to buy property and they are able to support the property prices. So if you go to a market where you have high unemployment rate like 5% or 10%, no matter how cheap their property prices is to you in Sing dollar term, but if there are people cannot afford to buy the property, then you don't have a resale opportunity. So it's also well known in the market that if you talk about resale opportunity, nowhere else in Southeast Asia is as liquid as Singapore. If you try putting up a property for sale in Singapore versus other places in the world, you find that the kind of leads, the kind of buyers who are coming to you is probably much faster, much more compared to many other countries in the world. So Singapore is a very liquid market. So we use liquid market to define Singapore property market. Another example of a liquid market will be London. So therefore, when people look at Singapore, they won't compare Singapore with Jakarta, Manila. They will compare Singapore with all the major gateway cities in the world, which is London, Hong Kong, Beijing, Shanghai, Sydney, New York, that kind of places. So Singapore is in that international league. And of course, we have good quality housing. Singapore real estate industry is well regulated. The developers who build projects for us are well regulated. And if you don't have that kind of financial strength, you can never be a developer in Singapore. In some other third world country, even you have 10,000, 100,000, you can be a developer. Anyone can be a developer. But in Singapore, if you don't have that kind of financial strength and that ability, you cannot even have the license to be a developer. So the Singapore government has made it very, very tough for poor players to even enter the market. And last but not least, Singapore has very strong currency. A lot of times when you talk about protection of our wealth, we tend to look elsewhere, but actually closer to home, our currency is one of the strongest and most resilient in the world. This is some stats to show the resilience of the Sing dollar. Returns of investment. So now we talk about, after talking about international, we go deeper into local now. So what we see here is that the condominium rental market is performing quite well last year. I think partly because there has been not much supply coming on stream for the last few years due to the cooling measure. And I think there are still some foreigners who are coming in. And third, there's also some displacement of en bloc sellers. So rental is coming back. As mentioned here, the supply of GLS and BTO still remain low, and the leasing trend within the city-state appear to be positive. And some people are going for shorter lease, and prices of private condominium remain flattish. So the rental yield is actually improving according to our PropertyGuru report. And we have actually gotten some numbers from PropertyGuru portal itself of some surrounding projects around this location. Park Olympia, the selling price, asking price is between $500,000 to $1.8 million. And this is a sales PSF, and we have a rental price range. And then we have Hedges Park, and then we look at the rental price range, Palm House and all that. So after we did some computation, we derived that the yield is probably about 3%. Based on our computation of the rental returns. Of course, maybe after you deduct all the commission and the maintenance, maybe the net could be about 2%. But I think it's still quite healthy for a mature market like Singapore. You cannot expect to have 5 to 6% in a mature market. So we think this is quite healthy. And is there a risk that Singapore housing market is in oversupply? So the government does not have an interest to make the market oversupply because they don't want to make people angry. So they are going to tame down the GLS. And we know that when it comes to en bloc after H1 last year, after the new cooling measure, basically the whole en bloc market is dead. So actually there's no more supply coming up after H1 last year already. So this is talking about, yes, H1 there's a lot of supply where developers need to replenish their land. But Singapore government has been very prudent. Maybe to use the word kiasu is also correct. So the moment they see a lot of land buying by developer, they start to put a stop to it, and then they come up with cooling measures. So after H1, there's basically no more new en bloc happening already. So I think that's one thing you can say good or bad of the Singapore government. They try to look ahead. So they look at all these exuberance, they immediately tame it down. So Singapore is probably one market in the world that you won't see any bubble. There are many markets out there like Hong Kong or Beijing where there are bubbles because the government usually reacts. They are reactive. Only when the prices run away, then they start to tame it down. But I think Singapore government is very proactive. Before even that happened, they really tame it down. So I guess that is where the play safe syndrome has for Singapore. So, and also with a taming down of supply by the government, the housing demand from the HDB upgraders and en bloc sellers remain strong. We see a tripling in potential demand from HDB flat owners who are eligible to upgrade to condo after their 5 years MOP. I think the Singapore dream of owning a condo or staying in a condo still remain. And HDB upgrader make out half of all the private homes sold by developer, and they are the biggest contributor to housing demand. Can I have a show of hands? How many of you are currently owning one HDB flat? Or maybe you're shy. Anyway, what this cooling measure have done is effectively is telling the investor to first step aside, and then you say now is the best time for those who are HDB to upgrade to a condo because there's not much of an investor to compete with them. And I think secondly, it's also a good time for those first-time home buyer because again, they have less competition when it comes to prices. But of course, for investor, not to worry, later in my slide, I also have some slides to give you some tips on how you can optimize your tax. Not evade tax, optimize your tax to minimize paying so much tax when you want to do investment. So the bulk of the nearly 20 billion en bloc payouts to displaced homeowners from deals announced over 2017 to 2018 have yet to be deployed back into the market. So many en bloc sellers, they take the money Some of them are taking money this year after they sold last year, and they need to buy something. They need to buy a replacement home. So this money has not been redeployed back to the market. So this money will likely be able to absorb those new launches that's happening this year. And our GDP growth, our household income, unemployment rate is still remain healthy. So far, we don't have major retrenchment exercise. Everybody have their jobs. So everybody income is there. So stability is there. So just now back to my point, let's say now we say it's a good market for upgrader and for first-time home buyer because the investor getting harder to compete with you, right? So what about for investor? What can you do? So the first thing we need to note is that the government has made it very clear. Gone are the days where you can make a lot of money from HDB. So when you're owning a HDB, you cannot expect to make a lot of money from it. So if you currently own a HDB, you just need to know that you are just consuming it, but not owning it, because I think you guys have read the news about the 99 years lease for HDB. So to grow your wealth using property, private residential market is the way to go, because private residential market is the one that really can give you the capital appreciation over a period of time. So ways to optimize your tax. If you currently own a HDB, husband and wife, what some people can do is that you can sell your HDB and you buy 2 private property using husband and wife name in each property, one for own stay and one for you to collect rental income as a passive income. So that's one way. The second way is if you currently already own a private property, you can decouple your existing private property and buy another one using your spouse name. So that way you don't have to pay ABSD. And the third way is if you currently already own 2 private property, you can buy a third one using a trust held under your child's name. But of course, if your child is already past 21 and he's already making income, you don't even need to form a trust. You can just buy under your child's name. So these are the 3 common ways that people who are investors will use to optimize their tax. Then the last question here is condo versus EC. So I think the advantage for condominium is that you can do decoupling. Basically, back to the strategy for tax optimization. You can't do decoupling when you go and apply for EC, because when you apply for EC, there's some characteristic of HDB. You need to form a nuclear family to do it. So condo give you the flexibility to do decoupling, and also for one person, one spouse to own the property. And and also there's no restriction on holding period. For this EC, there's a 5 years minimum occupation period, but for condominium, you can sell it perhaps after 3 years, after the SSD. And EC supply is tight, so developer can only launch the project 15 months after the site is awarded, but not for condo. And for condominium, you're not restricted to buy and sell. You can sell as long as the market condition is right. So these are some of the advantage of owning a condominium versus an EC. And the other point is approximately 70% of the supply of your units of EC is set aside for first-time buyer. So if you are not a first-time buyer, then you will not have that opportunity. Your opportunity is lower. And of course, buyers of newly launched EC face a mortgage servicing ratio cap of 30% of their gross money income. So these are some of the unique restrictions for EC. And for those who are second time applying for EC, will have to pay a resale levy of up to 50,000. Whereas for condo, there's no such restriction. So that pretty much sum up my talk.